Okay, we are recording now. Welcome, everyone. Welcome to our March meetup. We're very glad to have you guys here. We do a virtual meetup monthly and an in-person meetup quarterly. The next in-person meetup is going to be in May with a representative from Small Change, a crowdfunding platform for urban transformation. So we're really excited about that. That's going to be somewhere in downtown DC, so stay tuned for more details. Who we are is a community of folks who are either interested or already involved in real estate investment, and specifically crowdfunding. That's the direction that we are heading in as a community. We do educational and networking events. I'm a new organizer with the group. There's also Lou Steadwell and Elizabeth Jill Hooley. Unfortunately, they couldn't attend tonight, but they're usually with us. So we basically are here to help people expand their professional circle as well as to educate people about all. Sorry about that, you guys. I don't know what is going on with my internet. I apologize. Hopefully we caught most of that, but basically we are a resource for education and networking around real estate investment and specifically crowdfunding. And that's about it from me. We have an awesome guest tonight, Andrew Savikas, if I'm saying that right. Okay, awesome. So I found Andrew while doing a Google search for different crowdfunding platforms. He was a former CEO in the corporate training area and has kind of become a investment expert, maybe by mistake, perhaps. In his bio, he started researching different crowdfunding platforms in 2016, and everything was overwhelming and confusing. There's so many options and the different regulations and everything like that. So he decided to start documenting his journey on his blog, yieldtalk.com, as well as started a document listing the different investment options, crowdfunding investment options. Sorry, my internet is acting up. And now it's become a database of over 100 platforms, and he gives really in-depth and resourceful overviews of the different platforms available. So tonight he will be joining us to talk specifically about I'm really sorry about that. I don't know what is going on with my internet. Okay, I'm going to quickly pass it over before my internet goes again. But we're excited to have Andrew here, and he's going to be discussing crowdfunding for real estate crowdfunding for newbies, specifically the SEC regulations, as well as options for unaccredited investors. So Andrew, I will pass it over to you and hope that your internet is better than mine. And if anyone has any questions, you can go ahead and put it in the chat box. And then we're going to have a Q&A period after Andrew's presentation.
Able to see, or maybe I will see the chat things, but I might not be able to address the questions until later. But if you think of something, go ahead and pop it in there. Can everyone see what appears to be a slide on the screen?
Got it.
Got it? Okay, great. Thank you. I'm super thrilled to be here with you. Thanks, Mallory, for the invitation to join the Real Estate Financing and Crowdfunding Network meetup. And besides thanking you for sharing your own valuable time this evening, I want to congratulate all of you for wanting to take the steps to educate yourselves and build out your own knowledge in this exciting and quite fast moving, but sometimes quite confusing new ecosystem of investment opportunities. This is just a fantastic time to be an amateur investor, but of course, as the saying goes, with great power comes great responsibility. And I'd like to start by sharing a few quotes to kind of help get you into a learning mindset. My day job for most of my career has been as an executive in the corporate training world. So I think a lot about learning and often find it a helpful reminder to kind of step back and bring, as Mallory mentioned, You'll Talk, the site I publish, really started as a way to document and share my own experiences in this kind of brave new world of investment crowdfunding. And I'm just thrilled to be here tonight to share some of what I've learned along the way in the hope that it can be helpful for some of you. And before I get into some of the practical kind of nitty-gritty and details about investment crowdfunding, I do want to share just a brief window on that learning journey that Mallory described, in the hopes that, again, that some of you find it useful and helpful in your own research. Before 2016, I had never made any kind of real estate investment besides for a time owning my own home. But after making a few investments in startups and doing some angel investing on some of the new crowdfunding platforms like Funders Club and AngelList, I grew more and more interested in diversifying into different asset classes, including real estate. But as I started looking around at what the choices were, I soon found myself just really feeling quite overwhelmed. I found there were just dozens of different platforms. More than that, seemed like new ones came every day in my own Google searches, offering just a dizzying array of choices about what options were out there and what the investment types were. And I found myself really kind of struggling with something I'm sure some of you have encountered, which is this sort of analysis paralysis of having so many choices that it's difficult to really move forward. And I found a way to break through that, which was really to ultimately conclude that what I wanted to do was decide on the maximum amount I was comfortable just losing entirely in order to learn something useful. I was really primarily treating it as what would I be comfortable treating as a educational expense, even if I didn't see $1 back in return, that I was going to feel like what I was getting out of the experience was knowledge to help me further my own perspective, so that next time around I would feel more confident in my choices. And that made a big difference sort of psychologically. Even though I ultimately knew I did want to invest quite a bit more in real estate, limiting those stakes early on to a relatively small amount really dramatically reduced my anxiety about making a bad decision, because it kept the stakes much lower. And that, for me, meant that rather than trying to figure out the right mix of debt and equity, or determine the best geographic market, or pick between commercial and residential, and again, as someone new to real estate, these were all new concepts in that space. So it was a lot to digest and absorb. I could instead really focus on just finding one investment that looked reasonable and that I felt like I could learn the most from. And that was really an important sort of transformative step for me along the way. And I've since gone on to do quite a bit more investing. And speaking of that, I do want to just make a few quick points before we proceed. And just to clarify, I'm not an attorney, and I'm certainly not a financial advisor. I'm not trying to offer you any specific financial advice or any comment about any particular investment or platform. I really hope to be able to help you help yourself in your own education about this ecosystem, and would always, of course, encourage people to seek professional advice before making investment decisions. One of the reasons it's easy to get quickly confused in this space is because the news and information out there is filled with a lot of jargon. This is a recent headline from Crowdfund Insider, and if it leaves you scratching your head a bit, you're certainly not alone. But don't worry, before our time is up here, I hope you'll be at least a little more able to parse out a headline like this and start making some sense of what this actually means in practical terms for you as a current or prospective investor in a crowdfunding platform, like an equity multiple, which is one. These are just a few of the terms and acronyms that you are likely to encounter if you spend any appreciable amount of time browsing investment websites or reading online discussion forums, or talking at meetups, for example. And, some of these terms do have very specific legal implications, and it can be intimidating to keep running into them. And at the very least, it's simply confusing, especially to kind of newbies to the area. And I have 2 young children, and looking at these terms this way actually reminds me of something I see a fair bit of these days, which is sort of alphabet soup. So let's see what we can do together here to try and make some sense of that sort of jumble of letters and numbers, and start to try to understand what that means for you as an investor. So one way to start to try to simplify things is to really start thinking about the terminology along 2 key dimensions. They're related, but they are distinct. So there's what a particular category or term or classification means about you, the investor. And secondarily, what it means about the offering itself, and that can mean the investment and also the platform where you may be using to buy that investment. So let's start with the most important of those 2 dimensions, which is, of course, you, the investor. As you're considering different investment platforms and offerings out there is an important classification that you should be sure to know about yourself. And some of you may have sort of heard this term before, but it's really whether or not you are what the Securities and Exchange Commission, also known as the SEC, calls an accredited investor. And contrary to what you might think from the word accredited, there is in fact no test and there's no certificate. The classification is really just a very straightforward threshold based on either your income. So if you earned more than $200,000 or combining that $300,000 with your spouse in each of the past 2 years, and can reasonably expect the same for the current year, or if you have a net worth of more than $1 million, either alone or together with your spouse, excluding your primary residence, then congratulations, you are now an accredited investor. The reason this is important is because many investments offered on crowdfunding sites can only be sold to accredited investors. The logic goes that if you earn this kind of income or have that kind of net worth, you are presumed to be, right or wrong, presumed to be sophisticated enough to evaluate investments that don't come with the kind of regulatory disclosures and protections associated with publicly traded stocks and bonds or mutual funds. But the reality is that only about 8% of U.S. households qualify as accredited investors, which for most of the past century or so has meant that the remaining 92% of households have not been able to participate in some of the kinds of investments that wealthy people and institutional investors have long used to provide more diversification and better overall returns. But in 2012, that started to change. Congress pulled together an assortment of proposals that had been in progress in some form or another for a number of years and bundled them together into the Jumpstart Our Business Startups Act, also known as the Jobs Act. And one of the goals of the law was to make it easier for companies to go public through the IPO process. Another goal, more for our discussion, is that it was intended to help make it easier for companies of all sizes to find financing, in part by lowering some of the regulatory hurdles, but also in part by opening up the pool of potential investors to include that 92% who had been left out for so long. But while there were a lot of positive outcomes of that legislation, something else it produced, as laws often do, is a laundry list of new terms and categories. And we'll talk a bit more about each of these because the differences are important to understand. Now, to be clear, I wouldn't expect any of you to leave this presentation as an expert on crowdfunding regulations, but I do hope that you'll remember that these terms have important implications so that as you do your own research and due diligence, you'll be better equipped to ask questions and review investment materials. So I will talk about each of these in more detail, but just as sort of a broad strokes set of buckets to think about, there is a set of platforms out there and the offerings they offer that's referred to as Regulation D. and that's the ones. Some of the ones you might have heard of that fall into this category are equity multiple, which I mentioned before, Peer Street, Patch of Land, Realty Shares, InstaLend. There's quite a number of them. There's another category known as Regulation A+, and this category includes some other ones that you might have heard of: Fundrise, Rich Uncles, Ground Floor. There's another category that includes the folks I think who will be the guests at your next meeting, which is small change. That's Reg CF, which is short for Regulation Crowdfunding, which I'll talk about in a minute. There's another category that I think is worth knowing about, which is there's certain platforms that I'll refer to as intrastate, which I'll talk about what that means shortly. And then the other category that I think it's worth keeping track of and not losing sight of, especially for this audience, is it's not really crowdfunding per se, but places where you can buy and sell real property, actual houses, rental properties. There's a Roofstock and Home Union come to mind there. So the first kind of broad category to think about with these platforms is Regulation D, or Reg D for short. And that is a category that most private real estate investment funds historically have fallen into. That is the original exemption to the SEC requirements to register with them when you sell a security. Instead of having to go file to sell on an exchange and file a bunch of documents, they had this exemption, which meant if you could reach certain criteria, you didn't have to file a load of paperwork with the SEC. And one of the ways that they could justify that exemption was, again, it was only offered to accredited investors. And so the Jobs Act made some minor, but I think important changes to that original framework, which is to kind of split it into two halves. So it's still fundamentally about private investments being sold to private individuals and limited to accredited investors. But there was a new kind of a category, a subcategory of those, and these are known as those that fall under Rule 506C. Don't worry, there won't be a test at the end of this. But the important thing there is that it allows for the first time companies offering these investments to advertise publicly. So historically, if you were selling investments in a startup, or you were offering shares in a private real estate fund, you couldn't put an ad out in the newspaper, you couldn't buy Google ads, you couldn't send email marketing about these things, again, because it was very important to limit the audience to these accredited investors. And one of these changes meant that on the one hand, companies making these offerings can now actually advertise more broadly, which is why you see all this advertisement from Peer Street and others, and it sort of opened the floodgates for some of that. However, it does mean that those companies that choose that route for their offerings, on the one hand, they can advertise more widely, which can help them attract more prospective investors. On the other hand, it means that they have an obligation to be much more thorough in verifying that their customers are indeed accredited investors. So if you sign up with one of the platforms that is sort of under the old framework, you more often than not, you're checking a box. You're saying, yes, I affirm that I am accredited. I meet these requirements. And it's really, they're relying on you to sort of self-certify or self-verify those criteria. And that has been determined to be sufficient for sort of covering their bases. When they're getting into this category of advertising more broadly, there's a much more rigorous verification process. So oftentimes involving uploading pay stubs or tax returns for a couple of years, that sort of stuff, as a way to verify. And there's even third-party companies that have emerged to fulfill that role of verifying accreditation status. So this is the specific rule that emerged around equity multiple, which had been choosing this route to open their audience more widely, but has discovered that it in fact has created more friction for them. They've made the decision to actually now go back to that other category. So again, Regulation D is still probably the biggest category of crowdfunding investment offerings. The majority of the crowdfunding platforms out there are offering their investments through Regulation D. But that is changing. But these are most of the ones that you will encounter, especially in your sort of own research online are going to fall into this category. So the next kind of important category is those that fall under what's known as Regulation A+. And there had been a Regulation A, and this is their sort of improvement on it, Regulation A+. And it has a lot of other parts that have to do with companies lining up for IPO and other things like that. But it also encompasses a number of crowdfunding platforms. And the important things to note about these platforms is they are open to all investors. So that's anyone basically 18 or older, even non-US residents in most cases. There are some pretty significant SEC disclosure and reporting requirements for issuers who want to raise funds this way. You have to file lots of detailed financial statements, in many cases audited and that sort of stuff. And it gives investors a lot more things to review that start to resemble, although not nearly as much detail, but start to resemble more traditional SEC filings that you might see if you've researched stock market companies and that sort of thing. And there's two flavors of Regulation A+, that aren't important for you to remember the details of, but just to know that there are some distinctions. And one is that there's a level where companies can raise up to $20 million under what's called Tier 1. And there are some limits into how much a non-accredited investor can invest in one of those. And the limits are determined, again, by income and net worth. It's sort of a sliding scale. And there are not quite so many of the documentation requirements for the company. And there's also a Tier 2, which is up to $50 million. And in that case, there is no limit for anyone on how much they can invest, which I think is an interesting kind of footnote on these, that there is this category where a non-accredited investor who has the resources available can put a significant amount of money into these. I'm not suggesting that's the right choice, but that is out there. And a lot of the new sort of flavors of REITs, of real estate investment trusts that have emerged in the last few years, ones like Fundrise, Rich Uncles, Realty Moguls, they've got a version of this, fall into this category of Regulation A+. And typically they create an entity or a structure that then issues shares to investors. And that entity may go and buy properties or do other things with that funds. And these are notable also because they can be sold directly by the issuing companies. So, Fundrise is an interesting one as an example, because on the one hand, they're selling these shares in these REITs that they've created under Regulation A+. They can sell those directly to you as an investor. But they also decided to sell shares in their own company itself through this process as well. So it's an interesting way of there's a few platforms in this space have started to not only use this as a way to facilitate a marketplace for investment offerings or participate in real estate investment, but also to bring funds in and investment into their own organization, which is sort of an interesting piece of this. And that is a little different from the next category, which is short. The short term is Regulation CF, Reg CF, which is short for Regulation Crowdfunding. And this is the most sort of pure kind of crowdfunding one. This is the kind of the ecosystem kind of came at it from two sides. So on the one hand, I'm sorry, I just got some kind of an alert message here. On the hand, you have those Regulation D, and then it starts to open up a little bit and become more open. And then you have so that's the traditional private investment vehicles. And then you have crowdfunding in the sense a lot of people think about it, like Kickstarter or Indiegogo. And in this case, it's sort of like looks more like that with investment tied onto it, not just rewards or donations. And this category of offerings, again, anyone can invest. As anyone over 18, U.S. and non-U.S. residents as well. And you can invest at least, regardless of your income and net worth, you can invest at least $2,000 in any 12-month period in these offerings, and that's combined. So maybe it's $100 in 20 offerings or $2,000 in one offering. The important thing is there's a 12-month period limit, and that's the minimum. And then it goes up based on your income and net worth up to a maximum of $107,000 in a 12-month period. And that limit even applies to accredited investors. So even Warren Buffett can't invest more than $107,000 a year in Regulation CF investments. And there is a limit on the total amount an issuer can raise in these investments, which is about $1 million in a 12-month period. And so this really is geared toward small companies, small businesses, small projects. There's lots of debate about whether these limits should be changed, but for the time being, this is what they are. This is the framework that Small Change is actually using for some of their projects, where they're able to do projects that they can do with $1 million or less of cash. Not that they might not also supplement that with other financing, but in terms of what they're raising from the sort of crowd, so to speak. A couple things worth pointing out about those investments that qualify as Regulation CF. All communication about the investment has to be done online. So all of the messages that are come out from the issuer, all of the disclosures, all that has to happen online. They all have to have basically an open online forum where people can ask questions and they have to answer the questions. All the documents are posted online. And that has to happen through one of these, what's called a funding portal, or through a broker dealer, which is a certain category of person or firm that's licensed and regulated by the SEC to offer securities to the public. But most of these Reg CF investments are coming through these what are called Title III funding portals. So Small Change, again, is one of these where they agree to meet certain criteria like opening up these forums, posting the questions, doing a certain amount of review of issuers, background checks, that sort of thing, and are responsible for their own sort of ongoing filing and disclosure. And just to because this wasn't already confusing enough of an ecosystem and space, many platforms are also doing what's called side-by-side offerings, where the underlying investment may be in a particular company, but they're offering it through one or more of these things. So typically what happens is if you show up there and you say, I'm interested, they say, are you accredited? And you say no, then you get funneled to the Regulation CF version. And if you say, yes, I am accredited, they put you into the Regulation D. That gives them the sort of best of both worlds. They can raise money from a broader pool, but they're not capped. That limit only applies to the amount raised through Regulation CF. They can raise as much as they want through Regulation D. So there's some reasons why from the companies raising it makes sense, but it does add complexity for investors in evaluating these things. I'm sorry, there was some kind of a message that came up from the...
Was it from the
Zoom
meetup?
It was, and it's not, no, it's okay, but it's not letting me advance my slide now, so let me just try to see if I can...
Yeah, we usually use another account and it just popped up on the screen. You need to upgrade your account.
Okay.
So
no, it's fine. I understand. I just wanted you to know I was getting a little, okay, now I think we're back.
Okay, good. Yeah.
We are back. Okay. So the next category that is important to sort of understand that some of them fall into this is what I'll refer to as intrastate offerings. So another thing that happened as a result of that 2012 Jobs Act is a lot of states decided they wanted to get in on the action, and the SEC made some changes to their requirements, and a lot of states got together and I'm sure had lots of boring meetings. But one outcome there is that it opened up the possibility for individual states to choose to implement their own kind of crowdfunding frameworks. And as long as they limited it to companies that were in the state and only to investors in that state, they could also sort of avoid the SEC sort of regulatory framework. And so what that means in practice is that now more than 35 states, including I think also the District of Columbia, have passed laws permitting non-accredited investors to invest in various flavors of crowdfunding. And while a lot of it has focused more on businesses, business loans or sort of startup and angel investing, I do know that there are some real estate ones out there. And in particular, I know that there are some private operators who are using some of these to construct their investment funds so that they can bring money in from non-accredited investors. and I'll talk a bit more about this later, but the details vary tremendously. In some states, there's minimums and there's maximums and there's limits, and in some states it's maybe $500. In some states there's no limit. It's all over the map, so to speak, literally. And so that's one where, if you're interested in making sure to understand all of your options, it's worth probably poking around your own state's information to see if there may be some opportunities that you're able to invest in because you are a resident of that state. And the sort of final kind of high-level category that I want to put out there within the context of this crowdfunding ecosystem is one that isn't really crowdfunding at all, in the sense that it is not about selling a security. SEC regulations are about securities, but really, buying and selling actual properties, the kind of things that a lot of you I know have started to do, rental properties, especially, that kind of thing, or fix and flips. And of course, with those kind of properties, that there's obviously no accreditation requirement there. There's no minimum income or net worth required. If you can get the financing, if you have the down payment, if you can pull the funds together, you can buy the property. And it's worth noting in this context, because along with some of the, you can make the case that some of what has powered some of the crowdfunding ecosystem is the underlying technology platforms and the comfort people have with doing business of fairly significant transactions online. And that also has impacted buying and selling of property as well. And there's at least, if you're starting to look at real estate and starting to look at online investing, you should at least know about some of these other services, and some of you may have heard about these, but platforms that are now offering, in the same way you can go on some of these crowdfunding sites and buy, invest in properties, you can go on to a Roofstock or a Home Union, there's a few others, and actually do the entire transaction of buying a rental property and looking for one, all online. And in some cases they offer a sort of bundled it's kind of a turnkey service as well. But again, just to put out there as another part of this space. So there are I think let me just quickly sort of summarize the investment limits associated with these categories, and this is divided between accredited investors and non-accredited. And I think it's just worth thinking about as you're evaluating and looking at investments, understanding kind of where you fit in and where the investment fits in, to understand what your sort of maximum investment potential might be in some of these. So I think this will be shared later on as well. So I think there's three key implications of these different categories for understanding what it means for you, the investor, and for the offering. So one category of implication is around disclosures and regulations. So whether or not the company, and what amount of information the company has to provide ahead of time. So if you're reviewing a Regulation A investment, for example, you know that along the way this company had to file fairly detailed paperwork with the Securities and Exchange Commission, who isn't necessarily approving it, but that there is this sort of paper trail. On the other hand, a Regulation D investment, it's really, again, kind of it's buyer beware there. The assumption is people investing in those are sophisticated enough to make informed choices about that without a lot of sort of regulatory oversight. And so, really the only requirement for, there has to be a private placement memorandum, which on hand does, as I know, and on the other hand, it really doesn't have to be any more than what the investors sort of demand. So there's a wide variety of depth and detail in what you'll see in the investor materials for Regulation D, and that's kind of different from what you'll see with some of the other categories. And there are implications on the curation and due diligence side. There are certainly some investment platforms out there that are really emphasizing that they're doing the heavy lifting of the curation. You'll see this in many cases. If you start looking at these things, you'll see they all want to claim that we only accept 1% of investments. We only look at, we look at 100 of these and only one of them we're going to post because we do all of this evaluation and all this analysis and all of this kind of due diligence. And certainly if you believe them and you agree that they're doing a good job, that may be a great option. On the other hand, there are some that explicitly will say, you know what, we really think the market should decide whether these things are worth investing in. And basically, once an issuer meets just the baseline requirements, will get listed on the platform. And that's, I'm not suggesting I know the right answer or not. Then there's probably room for both of those. But I think one of the things I discovered early on, I think kind of the hard way was, what was when I made an investment in a startup through a platform that I didn't really realize was in that category of kind of a, hey, let the market decide. And so I had gone into it, and I blame myself for not doing my own homework in more detail. But I made an investment thinking that this platform had in some ways sort of, had said, sort of put the stamp of approval on it, and that's wasn't their approach at all. It was really up to the investor to really make that decision. And another thing about this that's worth keeping in mind is there are a lot of implications on the side of the platforms to collect information about you as the prospective investor. So one of the things that can get really scary when you first start looking at these things is how much information they want to know about you, whether it's they want to see tax returns or bank account numbers or social security numbers or whatever it is. But a lot of it is really a requirement of what's known as know your customer laws, which have to do with anti-money laundering and compliance with SEC regulations. So it's not to say you should be casual about sharing important financial information with a potential platform, but in many cases that's kind of par for the course with these investments, and that can be a little bit off-putting to someone coming into this, but it is just the reality of these investments. So as you start to review crowdfunding investment opportunities and looking at some of the platforms and looking at some of the investments, I think there are four broad categories of questions to think about when you're doing your own due diligence, which is the stuff you're supposed to do yourself to evaluate the suitability and quality of an investment. And these actually came from a discussion I was fortunate to participate in with some folks from the industry, including some experienced commercial real estate developers, some attorneys, some folks in the kind of startup side of it. But these sort of four categories of due diligence for crowdfunding investments came up again and again in the conversation. And one is understanding the type of security. So getting into the details was certainly beyond probably the scope of. We could spend a lot of time digging into it, but to make sure you understand, there is a broad spectrum of different kinds of securities out there. So especially if you're coming at it from someone who's done real estate investing and maybe done a little bit of stock market investing, maybe bought some ETFs or mutual funds, the size, shape, and flavors of securities associated with these crowdfunding things is really for better or worse, just all over the map. So, in some cases, it looks like you're getting common stock in a company. In some cases, you're getting membership interests in an LLC as a special purpose vehicle. In some cases, you're getting sort of a secondary instrument called there's one that's out there that's known as a borrower-dependent payment note. And that's one where ostensibly you're funding a loan to help someone buy a property, for example, to fix and flip it. But the reality is you have no security interest in that property. What you're getting is you're basically getting a promise from the platform that says when someone pays on that loan, you'll get your proportional percentage of that payment. But if the loan goes south and the buyer defaults, you're not really in a position to come and sort of use you don't really have a claim on that property. And it's important to understand that and know in which whether what you're getting is what kind of instrument it really is. And again, it's important to really be aware of the curation and diligence process that the platform may be performing. Is there, what are they suggesting that they are doing specific review? What kind of criteria do they have? They all say they do it, but what does it actually look like? Who is doing it? Is there a committee? Is there specific published criteria? Do they publish information about it? Or are they really just providing a kind of a marketplace for issuers to offer investments? The third category for due diligence is really understanding whether it's appropriately matches the risk and return with the asset class you're looking at. And what I mean by that is this particularly comes up with people who may get into this space. Again, I got into this space thinking about it from angel investing and startup investing, and started to get into real estate and others. But understanding that there are very different risk and reward and return expectations for venture capital versus real estate versus litigation financing. And it's one of those things where, especially if you're starting to dip your toes into an asset class that you're not familiar with, that's an important thing to make sure you're educating yourself on is are you understanding whether the return you're getting is a good match for the risk that's associated with this kind of asset. And then, another important question to ask is what happens when things go bad? That's something that I, again, sort of learned the hard way with the real estate ones, is just how often there are delays. And this is probably not news for any of you who have experience with real estate projects, but it was an eye-opener for me how often there are delays with the projects, and how often there's payments are late on loans, and how often the loan really kind of gets into trouble. And many times it can be resolved, but it's helpful to understand what might happen if the borrower stops paying on a loan that you're helping to fund, or what's the process in place for the platform to help recover that investment. And really that sort of opens up, and I'm not going to read all of these. This is a lot of text that I'm sure Mallory will be happy to send these out afterward. And I've actually taken this from a blog post that I did recently. But it really opens up a range of questions that, as you start to evaluate crowdfunding investments, are the kinds of things that when you can answer these and when you feel like you're getting satisfactory answers from the platform, you can start to feel more confident in your decisions. And these are some of the things that fall out of those categories and classifications that I talked about, and making sure that you're understanding the distinctions and differences in these different categories of crowdfunding investments, and what they mean for risk and return and other things like that. So again, these are some questions that perhaps you might find helpful that I've sort of accumulated over time in reviewing a lot of different platforms and crowdfunding investment opportunities. So I also want to make sure to transition a little bit into diving a bit deeper into the investment crowdfunding options specifically for non-accredited investors. That time and again is a very popular topic. I see that in what people search for when they come to my site. I see it in questions that come up in different discussion boards. And there is definitely a lot of interest among people, especially people who are involved in the real estate industry but have not perhaps yet gotten to that accredited investor status, but really want to participate in some of these opportunities. And there's really kind of three different ways a non-accredited investor can successfully participate with real estate investing, especially in this with crowdfunding options. One is crowdfunding. One is the kind of sites that I've talked about, and that's obviously probably of most interest right now. But it's worth, again, pointing out that there are these sort of two other categories that non-accredited investors do have open to them, which is, one is direct real estate ownership, and the other is publicly traded REITs and stocks associated with the real estate industry, which again are easier than ever to find through, you can buy and sell real estate in different platforms. You can do lots of neat things to screen different real estate stocks and ETFs. But just to put out there that those are options that still remain available for non-accredited investors. But getting specifically into the kind of crowdfunding side of it, I'll draw your attention to specific several available not just to non-accredited investors, but for minimums of $500 or less. So when you start thinking about what are ways to dip your toes in the water, to maybe spend more time making sure what you're learning versus risking a lot of capital, there's a lot of options that have come out there that have emerged. So a few that I'll just mention, and I'm not endorsing or recommending any of these, but I'm putting them out there as examples of ones that are worth looking at if you're thinking about getting into this space and looking at something that has low minimums and good ways to get your self-oriented. The first is one, American Homeowner Preservation, and their model is they raise money through Regulation A+. They go out and they buy pools of distressed mortgages, and then they go through a process of either they'll often renegotiate with the homeowner to try to, their goal is to keep people in their home, so they'll renegotiate, and oftentimes they're able to then, once they establish a payment history, then they resell the loan at a profit. But that's their model, and they have, I think you can start with $100 is the minimum investment for them. And again, that's Regulation A+, which means it's open to everyone. Rich Uncles is another one in this space that has a minimum of I think it's $500 or perhaps even less. That's more of a REIT model where they're pooling money, they're buying in, rental properties, and you're getting a share of the income coming off of those. Ground Floor is another one. They started under those intrastate exemptions, but have recently expanded nationwide using Regulation A+ as their framework. Small Change, who I think you'll meet at the next meetup, another one in this space using regulation crowdfunding, one of the few, along with Dream Funded is another that are using this Regulation CF for real estate. So I highlight these just because they are options that are out there for a relatively modest minimum investment and are potentially interesting ones for you to look at and consider as possibilities. And again, the other possibility that's out there that is just there's too much variety in how they break down to talk much about, but there are exemptions within all the states that are shaded in green there, where varying by state, you may be able to invest as a non-accredited investor in a variety of different kinds of investments, including real estate. So, Mallory mentioned earlier that some of the data that I had started to pull together as part of my own journey here, and the way that's manifested is as you start to think about these things, if you want a more comprehensive list of what's out there, including information about what the minimums are, and whether they're open to non-accredited or not, or even what kind of investment they're, this is the URL for what's essentially a kind of a screener that is available on my site, where there's 101 different platforms listed, and then you can use the fields at the top to filter and sort these. This happens to be a screenshot showing all the ones I have in the system that are that offer investments in real estate that are open to non-accredited investors. So I think this is about 24 there. So there's definitely a lot to explore and a lot to consider. And hopefully now, as you start to perhaps poke around some of these, you've got a sense of what some of these terms mean, and maybe can help sort of smooth that education process. And I also want to at least briefly mention that, one of the things that got me excited about this space was that it wasn't just about interesting things happening in angel investing or new ways to get into real estate. It was this really novel way to get access and exposure to a broad range of asset classes that previously were very difficult to get into if you weren't able to write 7-figure checks or weren't part of a institutional investment organization. And so when you look at those 101 platforms that I've discovered along the way, and it seems like new ones pop up all the time, there's a really interesting, diverse mix of investment opportunities out there. Not all, but many with variations open to everyone for investing. And that ranges from things like real estate, of course, and venture capital, but even sort of exotic things like litigation finance or oil and natural gas rights, or you can invest in the performance royalty catalog of musicians, for example. There's some super interesting categories of things out there. And I bring that up because one of the things that got me into this field and this space, and that keeps me so enthusiastic and excited about it, is what this is really doing is opening up to a much broader audience the kind of investments that wealthy individuals and institutions have been using for years for diversification and improving their returns. So this table that I've shown here is from the annual report from the Yale University Endowment that shows the categories of things they invest in and how much they have in there. And what you see, and you can sort of compare there, you start to see the list of things that you as a crowdfunding investor can now participate in starts to look like the kind of things that previously you had to have a family office or be a university endowment to meaningfully participate in. And I think that's, while again it does bring a lot of burden of research and analysis and understanding these things, it also comes with a lot of new opportunities that I think are really exciting for investors. Hopefully with some of this terminology, you'll be a little bit at least better equipped to start analyzing and understanding the options that are out there for you. I want to thank you for the opportunity to share some of this with you. I haven't been able to see the chat window, but if there's questions, I would be more than happy to address those.
Thank you so much, Andrew. Yeah, if anyone has questions, most people are muted, so you can either unmute yourself and just talk, or you can go ahead and type your question or comment in the chat box.
I've left you all speechless.
Yeah, I was thinking I'm going to have to rewatch this again to really be able to understand, especially the regulation part of things. That's a lot of complexity.
Yes, and I wouldn't expect anyone to be able to really kind of parse all that out in one sitting. But if nothing else, I hope it starts to help people when they start to see these say, oh, that's important. I should make sure to go and look that up. And certainly I've got a glossary on my site and definitely lots of stuff that people can find more information. It is, I still remember I had to map everything out on a whiteboard because it was really confusing.
Mm-hmm. You got 2 comments. Community Builder says, that was a great summary seminar. Thanks so much. And can you mention your website again?
Yes, absolutely. It is yieldtalk.com. So I put it in the chat room as well. But everyone's welcome to check it out. There's a newsletter and there's lots of information there. And I love feedback and ideas for new platforms to look at.
How do you as far as your website, how does it make money for you?
Sure, that's a great question. So, and to be clear, it started, really as a bit of a labor of love on my own, sort of sharing what I've done. It does earn some modest income from a lot of advertising and affiliate advertising and banner advertising from some of the platforms that are in there.
I'm just speaking to you have like ratings on the various fund
Yep.
platforms, and I was wondering whether that was influenced by advertising at all.
No, and I'm very clear when people do want to advertise that it's well, on the one hand it's my opinion, but on the other hand it's only my opinion. So I don't in most cases they come to me after I've reviewed them and they'll say, we would like to sponsor this or feature this. But no, I try to be very clear with them that I want this stuff to be again, my opinion, but I want it to be useful and honest.
Okay, thank you.
And Andrew, you haven't used all of those different platforms, right? You've just really, well, I'm sure you've used a lot of them, but have you just really researched and gotten data from maybe people that have used the different platforms?
Yeah, so it's true. I have. So I've invested in I think 12 or 14 different ones at this point. But in many cases, what I try to do is summarize a lot of the things we've just talked about. So a lot of the reviews, I'm not trying to make an assessment whether the investment is a good one or not, but it's more, and I've got some information about how, what the sort of criteria are, but I want to save other people some time of like what, I try to summarize things in terms of what are the different security types, the regulatory work, what due diligence expectations, what are those kind of things that typically involve reading some of the investment summaries, digging through their documentation, sometimes talking with their customer support people or doing questions back and forth. But a lot of it's just trying to answer those kind of high level common questions that will help people kind of filter these down into a more manageable one before they kind of dive in. So I haven't invested in all of them, but I'm hopefully trying to provide some at least high level insight into the platforms and what they have to offer.
Mm-hmm. Wonderful. Yeah, as far as I haven't seen, just in my brief search, I didn't see any other website with a similar database. I haven't seen those comparisons. Like you'll see an article every now and again with, top 20 investing platforms, but nothing with that level of depth and comparison broad, like a really broad comparison.
Well, and I think some people sometimes you'll find some of those in, maybe within real estate or within venture or angel, but there's part of this came out of my own frustration in not being able to find information across the different asset classes. Because what I've discovered is a lot of people seem to be like me, and they end up kind of omnivorous. Sort of once you start in one of these investments, you tend to want to explore the other ones too. There's still a lot of room out there for more people to share their opinions and talk about these things. So, yeah.
Absolutely. Does anyone else have any other questions?
I have one other thing, I think, and that is one of my goals here is to diversify my assets, and I think this provides a very good platform for me to look at to investigate, I guess, the various options for me in the crowdfunding sector. Because when I first started this, I was going, I'm just going to diversify into real estate. Well, that's really not diversifying. So I'm kind of learning as I go that, it might be nice to go about looking into other forms as well. So I want to thank you for coming up with this kind of site, and for your time and your insights.
You're very welcome. Thank you for your time. I know it's not an easy thing to do to carve out time to come to these things, so I appreciate it. And I posted my email in the chat room. You're of course welcome to contact me there. There's a contact form on the website. If you have any suggestions or feedback or ideas, please, I'm more than open to hearing them.
Wonderful. Yeah, you've got a lot of community builders. Says thanks again. We appreciate your great work. And we want to thank you. The Meetup group wants to thank you so much for coming. And you have offered a great resource to a lot of people and a great educational resource. And I encourage everyone to visit the website. He, as you can tell, is very thorough and thoughtful person. You can see that in the writing on the blog, as well as in that database. So we're going to go ahead and wrap up unless you have any final comments, Andrew.
No, I think I've talked enough for one evening.
Well, thank you so much for that really thorough and detailed analysis and explanation of the regulations and the different options that are available. I would definitely love to get the PowerPoint so I can send it out to all the RSVPs and people who weren't able to be here. And as Andrew mentioned many times, thank you for plugging that. We have Small Change coming in May to the meetup, and they're going to be presenting on their platform what they do. So you'll get to see a little closer up what these platforms are doing. And we also have another virtual meetup next month on April 24th. And that is going to be about the actual rehab fund, which is going to be a crowdfunding vehicle that we're creating for DMV real estate investors to actually participate in some crowdfunding endeavors outside of these platforms. So we'll be doing a teaser for that on April 24th and in person in May. So if you guys have any questions, please, I'm Mallory Rose Pettis on Meetup, and you can shoot me a message. If you have any questions for Andrew, as he said, he left his email. And I think that's about it. Thank you all so much for coming tonight, and have a wonderful evening.
Thank you very much. Have a good night.
Thank you, Andrew. Take care.